Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about MILLERKNOLL INC. Quarterly Report. MILLERKNOLL INC. offers a wide range of businesses and services that cater to various needs of customers worldwide. The company's product portfolio includes seating products, furniture systems, textiles, leather, felt, home furnishings, case goods, storage products, and residential, education, and healthcare furniture solutions. The company operates through three main segments: North America Contract, International Contract, and Global Retail. It offers its products under various brand names such as Herman Miller, Knoll, Maharam, Geiger, Design Within Reach, Hay, Not One, Colebrook, Boston Saunders, Holly Hunt, and others. These brands cater to different markets and customer segments. MILLERKNOLL's products are used in various settings including institutional, health/science, industrial, educational, residential, and other environments. The company offers its products through multiple channels such as independent contract furniture dealers, direct contract sales, owned and independent retailers, direct mail catalogs, and e-commerce platforms. This diverse range of businesses and services enables MILLERKNOLL to cater to the needs of a wide customer base across different industries and geographies. MILLERKNOLL INC. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. MILLERKNOLL INC. trades at a higher price-to-earnings ratio of 95 times and a lower price-to-book ratio of 0.73 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The company have a dividend yield of 5.25%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified by examining the key factors that have contributed to an increase or decrease in revenue. On the growth side, net sales increased by 5.8% year-over-year, driven by a 9.2% rise in orders. The North America Contract segment saw significant growth, with a 13.1% increase in orders and a 4.4% increase in net sales. Additionally, price increases, increased sales volumes, and favorable foreign currency translation also contributed to revenue growth. In contrast, the primary drivers of revenue decline include lifestyle revenue decline across all segments and other segment revenue decline. The International Contract segment saw a decrease in organic orders, contributing to the overall decline in revenue. Furthermore, adjusted diluted earnings per share decreased by 2.3% year-over-year, indicating a negative impact on profitability. It is worth noting that certain factors had a neutral or mixed impact on revenue growth. These include currency translation effects, amortization of Knoll purchased intangibles, integration charges, restructuring charges, impairment charges, and debt extinguishment charges. The net income of the company experienced a significant increase in both the 3-month and 9-month periods ended February 28, 2026. Specifically, it rose by 289% in the 3 months period and 237% in the 9 months period compared to the previous year. This substantial growth can be attributed to higher operating earnings and favorable operating leverage. However, despite this improvement in net income, profit margins underwent a mixed trend. In the 3-month period, the operating earnings percentage increased from -36% to 2.2%, indicating a significant turnaround. Conversely, in the 9 months period, the gross margin percentage decreased by 1.5%, while the operating earnings percentage improved from -10.6% to 1.5%. The reasons behind these changes are multifaceted. The increase in net income can be attributed to higher operating earnings and favorable operating leverage. On the other hand, the decrease in profit margins is due to several factors, including tariff-related costs, unfavorable foreign currency translation, and increased corporate unallocated expenses. These external pressures have had a negative impact on the company's profitability, despite its improved net income. The company's financial performance is a testament to its ability to generate significant operating cash flow. According to the provided information, the company has successfully produced positive operating cash flow for the 9 months ended February 28, 2026, totaling $135.1 million. This achievement is evident in multiple sections of the report, including page 4 and page 54, which explicitly state that the net cash provided by operating activities was a substantial $135.1 million. Furthermore, on page 55, it is clearly stated that the company generated positive operating cash flow, affirming its financial stability and health. The company's debt level has undergone significant changes over the past year. While the total debt remains relatively stable, with a slight decrease from $2,615.1 million in 2025 to $2,553.2 million in 2026, the carrying value of total debt has decreased more substantially, from $1,337 million in May 2025 to $1,310,100,000 in February 2026. Furthermore, long-term debt has also seen a decrease, from $1,310.6 million in 2025 to $1,278.2 million in 2026. The company's interest expenses have changed significantly due to various factors. The transition from LIBOR to SOFR benchmark rate in January 2023 has had a notable impact on interest expenses. Additionally, the refinancing of term loan debt during the current year resulted in a loss on extinguishment of debt of approximately $8 million. Despite these changes, interest expense decreased by 9.7% for the 3 months and 10.2% for the 9 months ended February 28, 2026. The financial performance of various regions has been analyzed based on recent data. A notable trend is observed in the North America contract segment, which demonstrated significant growth in revenue for both 3 and 9 months ended periods. The segment's revenue increased by $5 million and $16.8 million respectively, indicating a strong performance. On the other hand, the international contract and global retail segments showed poor performance. The international contract segment experienced a decline in revenue of $26.3 million for the 3 months ended period, while the global retail segment incurred a loss of $24.4 million for the same period. These results indicate that these regions require improvement to meet financial expectations. Management is emphasizing the importance of leveraging the company's collective brand equity across various lines of business as a key element of their business strategy. This suggests that they are looking to maximize the value of their existing brand assets and expand their market reach. In terms of financial outlook, management expects no significant impact from unadopted accounting standards updates, ASUs. This implies a level of confidence in their current financial projections and operations. The company also plans to fund its capital commitments through a combination of cash on hand and operational cash flows. With expected full-year capital purchases ranging between $120 million and $130 million, management is signaling a moderate level of investment in growth initiatives. Management's use of non-GAAP measures is another key aspect of their strategy. They believe that these measures provide a more comparable view of the company's financial performance across different periods, allowing for better analysis and decision-making. The company's financial activities have been marked by a commitment to returning value to its shareholders. One of the key ways it has done this is through dividend payments. The company has a history of paying out dividends, as noted on page 7 of the extracted summaries. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to reduce the number of outstanding shares, thereby increasing the value of each remaining share for its shareholders. Like dividend payments, this practice is also mentioned on page 7 of the summaries. Concerns about inventory buildup or supply chain disruption are valid due to several factors. Inventory buildup is explicitly mentioned as a concern on page 17, although no further details are provided. The potential for disruptions in the supply chain is also highlighted on pages 56 and 58. The ongoing conflict in the Middle East poses a significant threat to the stability of global supply chains. This instability can lead to broader inflationary and macroeconomic effects, ultimately affecting businesses' ability to serve customers within the region. Furthermore, the constraint on the availability of petroleum-based products will increase costs for raw materials, exacerbating the situation. The limitations on serving customers within the broader region and the disruptions in the supply chain itself are also major concerns. These factors combined create a complex web of challenges that businesses must navigate to maintain their operations and meet customer demands. That concludes the financial summary for MILLERKNOLL Inc. Feel free to comment below, and I will be happy to answer them when possible.